What's up, guys? My name's Connor King with Resolute Capital. Dave Ramsey is famous for his backing of 4 specific actively managed mutual funds, while Warren Buffett and Jack Bogle are more famous for their huge backing of passively managed index funds. Which is the correct one? Let's get into it. If you're excited about this video, please give it a thumbs up and subscribe to our channel where we post 2 videos every week. Also, this video is for entertainment purposes only, and you should always consult a professional financial advisor before making any decisions with your money. So here we have 2 great, compelling arguments. Dave Ramsey's total actively managed mutual fund guy, and then Warren Buffett and Jack Bogle, they're full passive index funds, low cost. And both of these 2 sides, both very credible. Dave Ramsey is a personal finance expert, totally knows what he's talking about. I mean, he's probably worth at least $100 million, if not more. Super wealthy, super generous, and he's made a ton of money from investing properly. And then Warren Buffett and Jack Bogle, they're also extremely credible. Jack Bogle, founder of Vanguard. Warren Buffett, best investor of all time. And so those 2 guys totally know what they're doing. They're worth billions each. Even though Jack Bogle has passed away, he was. And so both of these sides of the argument, very compelling, and they both are very good with data to back up. And also both of these sides, very respectable. They've both done great things in the finance and investment industry. So whichever one you end up deciding, they're both pretty good options. All right, so first, we're gonna look at Dave Ramsey's side and his beliefs about investing. First up, he's confident that you can achieve a 12% annual return each year. And I'm sure that he has from whenever he has been investing to now. And so his data would be correct in saying that. He says all the time when people call in and ask him, what should I be investing in? He always recommends mutual funds. And he always says that why would you invest into the total market when you can easily beat it just by going with mutual funds? And also in saying this, he's assuming that all these fund managers that he invests in to get his 12% will continue to do so over the years and keep providing a 12% annual return. And so in his mind, it's just a no-brainer to go with these actively managed mutual funds because he's so confident that you'll be able to continue beating and outperforming the market. He also says that it's worth it to pay the fees and commissions to these guys for managing your money and managing these funds, because he says that it will still, in the end, make you more money even after the commissions, which that can be a whole debacle in some people's minds. So that was Dave Ramsey's side of the argument. And now we'll look at Warren Buffett and Jack Bogle's argument. So their big stance is invest into low-cost index funds that just track the total stock market. And they say that doing this, you avoid paying the fees, you avoid paying taxes on turnover with the assets in the mutual funds. And so passive investing, they say, is a much better route to go. They love that no one is handling your money for you and that you're just letting it be invested into the stock market and then the market do the work. And also, since you're trading a lot less, then you'll ultimately pay way less in taxes. They also are very confident that as the country of America grows, so will the market grow, and this will also translate into your money growing much faster as well with America. And they're also very confident that picking and choosing which funds to go with and picking stocks for a mutual fund is just not sustainable long term. And so they really advise against that. Fees also really add up over time when you're investing into actively managed mutual funds. And so what starts off in the beginning as just a few dollars, in the end is tons of money that you're paying to fees just because of the way their business model works. Also, the vast majority of mutual funds do not outperform the S&P 500. There are some that at times do outperform it, but over the long run, it's very unlikely. And most people lose a lot of money after fees and expenses in their mutual funds that then dips their return below the S&P 500. And so they paid more and made less money than they could have if they would have just invested into the 500 index fund. Also, they're very big on past performance does not predict future results, which pretty much all sound investors are. but they really focus on that point, and they just lobby that there is just no way to predict what is to come in the future, and so you might as well just go with the total market. Also, finally, actively managed mutual funds involve a lot more risk than a passively managed one, and so, you know, could cost more and even more risky to invest in those. And so they're big on just, you know, why let someone else predict what is going to happen when all the market history proves that all these predictions are wrong. And so your best bet by far is to just go with an index fund that tracks the total stock market or the S&P 500, because that's the only guaranteed way to make sure that you'll get your fair share of returns in the stock market. Both sides of this argument have very respectable people behind them that totally know what they're doing. Dave and Warren Buffett, they've both made tons of money, and so it's so clear that they're qualified. And at the end of the day, you really just need to figure out your risk tolerance and figure out which one is the better option for you. I personally am more of an index fund fan, so that's what I do. But just think about what's best for you, and either one will, in the end, probably be fine. So thanks for watching this video. If you enjoyed it, please like it and subscribe to our channel, where we post 2 videos every week. Also, leave any comments or questions you have down below, and we'll get back to you. See you next time.